$74 billion in profit, 0.005% tax rate, legal for 20 years. This is how Apple did it. For over 2 decades, Apple booked most of its international profits in a tiny country of 5 million people. Not because the market was big. Ireland's economy is smaller than Missouri's. And not because Apple sells more iPhones in Dublin than in London. The reason was simpler. Ireland's corporate tax rate is 12.5%. That's less than half of what Germany, France, or the United Kingdom charge. But the real trick was never the 12.5%. It was a special arrangement between Apple and the Irish government that let the company legally pay almost nothing. Not 12.5%, not 5%, not 1%. In 2014, Apple's effective tax rate on its European profits hit 0.005%. That's not a typo. For every 1 million euros Apple earned in Europe, it paid about 50 euros in tax. The European Commission called it a legal state aid and ordered Apple to pay 13 billion euros in back taxes. Apple appealed. Ireland appealed. The case went on for 8 years. And in 2024, the highest court in Europe finally ended the fight. This is how a low-tax deal between one company and one country became the biggest corporate tax case in history. Ireland's 12.5% corporate tax rate didn't appear by accident. In 2003, Ireland permanently lowered its standard corporate rate to 12.5% as part of a strategy to attract foreign investment. The logic was simple. Ireland had a small domestic market. It had no significant natural resources. What it had was an English-speaking workforce, membership in the European Union, and the willingness to offer the lowest corporate tax rate in Western Europe. By comparison, Germany's corporate rate was 30%. France's was 34%. The United Kingdom's was 30%. At 12.5%, Ireland was less than half the average. The strategy worked. By 2015, Ireland hosted the European headquarters of Google, Meta, Microsoft, Pfizer, and Apple. Dublin's docklands became known as Silicon Docks. American multinationals routed hundreds of billions of dollars in profits through Irish subsidiaries. Tax revenue from corporations tripled between 2014 and 2022, reaching nearly 24 billion euros a year. For a country that nearly went bankrupt in 2010, this was a lifeline. But as you're about to see, the 12.5% was just the visible number. The real tax rate paid by companies like Apple was much, much lower. The trick wasn't the 12.5%. It was a structure called the Double Irish Arrangement. Here's how it worked. A multinational like Apple would set up 2 companies in Ireland. Both were incorporated in Ireland. But under Irish tax law at the time, a company was only taxed as Irish resident if it was managed and controlled in Ireland. So the parent company, call it Apple Sales International, was incorporated in Ireland but managed from Bermuda or another tax-free jurisdiction. Under Irish law, it wasn't an Irish tax resident. Under Bermuda law, there was no corporate tax. And under U.S. law, it wasn't a U.S. tax resident either because it was incorporated abroad. The result, a company that was, on paper, a tax resident of nowhere. A completely stateless entity. Apple's Irish subsidiaries owned the rights to sell iPhones, iPads, and Mac computers in Europe, the Middle East, Africa, and Asia. When an iPhone sold in Germany for 1,000 euros, most of that profit wasn't booked in Germany. It was booked in Ireland. Then, through a licensing arrangement, most of the profit was passed on to the stateless head office in Bermuda, where no tax was owed. The 12.5% Irish rate was only applied to a tiny sliver of the profit. The rest just vanished from the tax system entirely. The European Commission spent 3 years investigating Apple's Irish arrangement. What they found was stunning. Between 2003 and 2014, Apple Sales International reported $74 billion in profit. But almost none of that profit was taxable anywhere. The company had a board that met a few times a year, usually by phone. It had no employees. It had no offices. It existed only on paper. Yet this paper company collected nearly all the profit from every iPhone, iPad, and Mac sold across Europe, the Middle East, Africa, and India. In 2011, Apple Sales International reported $22 billion in profit. Its Irish tax bill, $10 million. That's an effective tax rate of 0.05%. By 2014, the rate had dropped to 0.005%. In a single year, Apple booked €16 billion in profit through Ireland and paid about €50 million in tax. Investigators from the US Senate called this structure the holy grail of tax avoidance. Apple's response: everything we did was fully legal. Ireland's response: this is just our tax code. The European Commission disagreed. On August 30, 2016, EU Competition Commissioner Margrethe Vestager walked up to a podium in Brussels and delivered a verdict that shook corporate tax planning worldwide. The Commission had concluded that Ireland's tax arrangement with Apple was illegal state aid, not tax avoidance, not aggressive tax planning, illegal state aid. Under EU law, member states cannot give selective tax breaks to specific companies because doing so distorts competition in the single market. And the Commission ruled that Ireland's 1991 and 2007 tax rulings for Apple had done exactly that. Apple was ordered to pay €13 billion in back taxes, plus interest, covering the period 2003 to 2014. With interest, the total climbed to over €14 billion. Apple CEO Tim Cook called the decision total political crap. Ireland's finance minister immediately announced that Ireland would appeal, not to keep the money, but to defend its tax regime. A country that had been handed a €13 billion check was, remarkably, fighting in court to give the money back. The back tax payment couldn't wait for the appeals. EU law required Apple to hand over the money to Ireland during the legal process. So in 2018, Apple transferred €14.3 billion into a special escrow account held by Ireland. The money sat there for 6 years. It earned almost no interest. It lost value to inflation. And both Apple and Ireland continued to argue it shouldn't be there in the first place. In 2020, the EU General Court sided with Apple and Ireland, ruling that the European Commission had failed to prove state aid. The money stayed in escrow while the Commission appealed to the Court of Justice of the European Union, the highest court in the EU. Finally, on September 10, 2024, the Court of Justice issued its final ruling. The Commission was right. The 2020 decision was overturned. Apple owed the €13 billion plus €1.2 billion in accumulated interest for a total of €14.1 billion. After 8 years of litigation, the money in the escrow account was finally Ireland's to keep. Apple and Ireland had lost. Here's the question that confused everyone. Why did Ireland fight for 8 years to not receive €14 billion? The answer is that Ireland's entire foreign investment strategy depends on being seen as a reliable, low-tax jurisdiction. If the EU could retroactively force Ireland to collect back taxes from Apple, then every other multinational with an Irish subsidiary had a problem. Would their tax arrangements be next? Would the deal Ireland offered in 2010 be reinterpreted in 2030? Ireland's Department of Finance estimated that the country's foreign direct investment base was worth more than €1 trillion. The $14 billion from Apple was real money. But the risk of scaring away hundreds of billions more was, in Dublin's view, far more serious. Ireland also officially closed the double Irish structure in 2015, giving existing companies until 2020 to restructure. New arrangements would no longer be possible. But the closure didn't touch the past. And it didn't stop multinationals from finding new ways to route profits through Ireland legally, using updated structures that comply with the rules while still producing effective tax rates well below 12.5%. When the double Irish was phased out, Apple didn't stop tax planning. It restructured. In 2014, Apple moved the residency of 2 key Irish subsidiaries to Jersey, a Channel island just off the coast of France. Jersey is not part of the European Union. It has no corporate income tax, and it offers bank secrecy protections that make financial reporting nearly invisible. According to the Paradise Papers leaks in 2017, Apple used the law firm Appleby to restructure Apple Sales International and Apple Operations International into Jersey resident entities. The restructuring preserved most of the tax benefits of the old double Irish, just using a different set of jurisdictions. As of 2024, Apple holds approximately $252 billion in offshore cash reserves. The effective tax rate on its non-US income remains in the low single digits. The exact structure is different today, but the result is similar. And Apple is far from alone. Google, Meta, Microsoft, and dozens of other multinationals have all restructured their international tax arrangements since 2015, routing profits through combinations of Irish, Dutch, Luxembourgish, and Caribbean entities. Here's what the Apple Ireland case really tells us. The modern corporate tax system wasn't designed for companies like Apple. It was designed in the 1920s, when most profits came from factories, ships, and physical goods that were obviously located somewhere. It was not designed for a world where most value comes from patents, trademarks, and digital services that can be licensed to any subsidiary in any country with a keyboard. Apple didn't break any laws. Ireland didn't break any laws until a European court decided otherwise 8 years later. The €13 billion ruling didn't really punish anyone. Apple still has $3 trillion in market cap. Ireland still has a thriving tech sector. What the ruling did do is establish that individual tax deals between countries and corporations can be challenged retroactively under EU law. That is new, and it may be the beginning of a much bigger shift in how multinational corporations are taxed. Or it may just be a €14 billion footnote on a much larger problem that nobody has figured out how to solve. If this story surprised you, there's a lot more where that came from. On this channel, we break down the tax loopholes, legal structures, and financial strategies that shape the global economy. If you found this useful, subscribe and hit the bell so you don't miss the next one. We'll see you in the next video.